All right, let's start with George's question on T&Es. Considering progressively building as a core holding, future looks bright with migration to ERP software, providing better recurring revenues and higher margins. Revenue and earnings growth looks strong around 20%, return on equity 37%, net debt to equity 58% with good low long-term debt. First half results look strong in both revenue and profit. Full year guidance seems good, and board ownership at least 7.7%. Would be better if it was higher, but it's okay. Looking at entry price below 15, and we're currently trading at almost 16. What concerns me is the price action seems to be consolidating since reporting and not reflecting the seemingly good results. Or am I missing something? Yes, I can tell you, George. You are missing something. To expect that the market will respond to great results is, omitting to appreciate that the future is always priced in. Let me just put it that way. The market has already priced those good results in, and the fact that we're getting no response is probably pretty normal. It'd be abnormal if good results brought another surge. Where the link is relative to expectations. If the market is expecting a good result and gets it, then almost nothing happens, which is not terribly dissimilar to what's happened here. But if the market is expecting a good result and the company lobs a fantastic result that's not expected to be that good, then yes, the price will take off. Or if they show a really good profit, but it's less than the market expected, then the price will go down. So it's not about the results per se, it's about expectation is the key thing that'll move the price. So the market cap, 5.1 billion. So I'm sure there's members out there listening to this who won't have ever heard of Technology One because it's not a high profile company, doesn't get a lot of media attention, but it's a $5 billion company. That makes it sizable. The board owns 8%, so they've got 400 million skin in the game. So that's very significant. I'd focus more on the amount of money than the percentage. 400 million is a lot of skin in the game. They're a cloud-based software solutions company that have input into account keeping, payroll, business analytics, etc. Government provides around half their business, education a quarter, healthcare 10%. And this is a company and this is a number that's always stuck with me over the years when I've looked at T&E, and I think I might have bought it once briefly as a trade, but I've never invested in it because I was always worried about the valuation, always seemed excessive to me. But the number that always stuck with me is this 99% retention rate. They obviously do a lot of things right. 99% retention rate in software is just extraordinary, and 78% of that is recurring revenue. This is why the company is so expensive, because the market just recognizes that they're just an extraordinarily good performer. Strong organic growth via product enhancements and also significant expansion in their UK operations. So, you don't want to see great growth, which is being driven heavily by acquisitions, because that can only go so far. So the fact that they're getting a lot of good organic growth is a really good thing. So, George, as you can tell here, I'm just ticking all the boxes as we go down. Their total addressable market is been estimated. These numbers are always very rubbery. You never know what assumptions the companies make when they calculate these addressable markets. But just to give you an idea, that they reckon their total addressable market is around 3 times their current Asia Pacific business. So plenty of upsides still, despite the growth. The annual recurring revenue was up 17%, so it was already high. It continues to get better, so it's not like they've peaked. Their software as a service fees form 69% of their total revenue. Their goal for annual recurring revenue is greater than 500 million by FY26, and that implies a growth of 13% per annum from here on. They capitalise roughly 50% of their R&D, so some companies capitalise it all. In fact, in my experience, most companies capitalise it all. In other words, they put it on the balance sheet. They don't expense it. They don't show it on the P&L. So it makes, in the short term, it makes the P&L look better than it really is. So it's a bit of accounting fudgery. T&E is sort of standing in the middle. They're expensing half of it. They're capitalising half of it. So they're neither conservative nor aggressive in their accounting is the way that I would sort of read that. Now, the founder, and I'm just amazed that the exit of the founder, Adrian DeMarco, didn't cause a bigger ruction in the share price, because he's been an incredible driving force, and he also sold half his shares. But the share price has held up pretty well. So obviously he's managed the transition, the succession in the company very well, because it hasn't bothered the market. This is the weekly chart. Let's look at the numbers. Earnings from 2019 have grown from 18, 21, 23, 27, 31, 36. Beautiful progression. That's what I like to see. Nice and steady, nice and strong. No big lumps and bumps in the progression. And so that gives you confidence that what the company is doing and saying is likely to manifest itself, and therefore the market is not going to get any negative surprises. The dividends also increasing very nicely. The expectation this year is they'll pay out roughly half of their profit as dividends, so they've still got plenty of wiggle room. If they want to make some acquisitions or make some further investments that impinge on the bottom line for a year or two, it's not going to stop them continuing the growth in dividends. PEs in the mid-40s. It's not outrageous. They're not 100, but when you look at the compound annual growth rate, the compound annual growth rate over the last 5 years on earnings is 14% per annum. Is paying 50 times trailing PE and 44 times forward PE, is that fair? It's right up there. I guess I can probably just swallow it, but this is fully valued, George. So I think you need to recognise that from a valuation point of view. But it is a stock that tends to be always fully valued. Therefore, you want to take opportunities like this, here and here and here. These are the opportunities that you want to take, and to a degree here. So, buying recently around 1450, around this 50-week moving average is, or just under it, is what you're looking for. Now, I can't tell you when this will come back down up to be beneath the 50-week moving average. But if you look back at history, you've got to say that it's almost a given. And since 2020, we've had 1, 2, 3, 4, 5, 6, almost 7 excursions below the 50-week moving average. So, we get a couple a year. Now, you might decide to attack this in incremental fashion. So rather than not buying anything until it dips below the 50-week moving average, and therefore you may miss out for the next year and end up paying a higher price anyway, what I would consider is just decide how much you want to build to in total, whether it's 4% or 5 or 6% of your portfolio, and then just buy in bits. And you might want to get your foot in the door on a bit of a short-term dip. We'll go back to the daily chart in a minute. Get your foot in the door, and then if we get a dip, down to say 14, then that's when you can start buying with greater confidence. Return on equity's really strong, 38, love that. Return on invested capital, 89. Interest cover, 60 times. Financially, they're as safe as a bank, so no worries there at all. Operating cash flow, 142 million positive, and cash, roughly 140 million in cash. So my overall comment, George, is they're just consolidating after a good result, and that's actually a great sign. So I wouldn't be at all disappointed that the price didn't take off on great results, because the good news was priced in already. Prices often fall afterwards, particularly with these high PE stocks, because so much has been built in advance. So the fact that this didn't is a very positive sign. It's always been expensive, still is. You're paying for the high probability that the earnings and dividends are going to keep escalating. If it were me, let's go back to the daily. If it were me, we're right at the top of the range. So the range is currently between 14.50 roughly and 16. So I wouldn't be buying here. I would see if I can get a little bit of a dip, even if it's sort of down into the 15.50s or 15.30s, something like that. So I'd get my toe in the door, and then I would wait, and I might be waiting 6 months for a better entry opportunity, which there you can load up further at a lower price. Tactically, that's how I would approach it.